Let's
Shall
hope
we
share my screen.
please share your screen and let's get started with the main dish for today.
Okay. Can you see my landing page?
Yes,
All
yes,
right.
yes.
So we're ready to go. Notice I refer to this as a mini MBA in 60 minutes. And I think when we get near the end, you'll all realize we covered almost every curriculum in an MBA program. There may not be too much time for Q&A. I've got a lot of slides. Put your seatbelts on. So you may want to take my email address that's on this, gcokins@garycokins.com, and you can directly ask me questions. And also feel free to invite me to connect in LinkedIn. So let's get going. Who am I? Gary Cokins. First, I'm 73 years old, but I feel like I'm 43 years old. Undergraduate degree was industrial engineering and operations research from Cornell. I got my MBA at Northwestern's Kellogg School of Management in 74. My first decade was in industry, FMC Corporation, then like about 30 years consulting with Deloitte, KPMG, Electronic Data Systems. And then for 16 years, I was with the SAS Institute, SAS, and I retired, I think, 8 years ago. SAS is, 15,000 employees, world's largest privately owned software vendor. It's a real privilege to be invited to come. I've traveled many countries for SAS. And when people say, where's your favorite part of the world? I always say Scandinavia, Finland, Norway, Denmark. I love being there. And I'm very aware of that organization that measures the happiest people on the planet Earth. And number one is Denmark. So that's great. So let's go. Who will benefit from this presentation? Professionals who have previously struggled at promoting financial planning and analysis, enterprise performance management, and integrating business analytics into their decision support systems. Professionals who intend to champion any or all enterprise performance management and business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is because it's been my observation, although it's nice for senior executives to advocate and sponsor innovation and new ideas, often they are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down in the organization chart who are passionate and ask themselves, how long do I want my organization to continue to perpetuate using stale and arcane methods? And there's the ones who will do a proof of concept or a pilot to demonstrate to their colleague line managers and executives above them, this is the way to go. So if you're 3, 4 levels down in the org chart, that's fine. I like presenting to you. My agenda, I'm first going to clarify the confusion and lack of consensus. What is this enterprise performance management? I'm going to briefly talk about business analytics. The majority of the presentation is going to be about 8 pressures that have caused interest in enterprise performance management. I'll do a deep dive into 3 or 4 of them. And then I'll conclude, quite frankly, with a frustration of mine. What's taking so long? Why is the adoption rate so slow? So let's start with EPM. There is confusion and lack of consensus. Is it human resources? If you just do an internet search on performance management, it's going to be about employee appraisals and so forth. The problem there is we had to put that E or C, corporate performance management, enterprise performance, they're synonymous. Is it about scorecards, dashboards, KPIs, and measures, or aligning strategy with the employees? Yes, but that's a subset. Is it about process productivity and quality improvement, like lean management, Six Sigma? Yes, but that's also a subset. That's referred to as business process management. Or is it all of the above and even more? And the good news is this: enterprise performance management is really not a new thing people have to learn, but it's basically things that people have already been reading about. You may not have implemented these various methods in your organization, but you're familiar with them. The problem is when organizations do implement them, they implement the methods in isolation. So we got profitability people in one part of the building. We got risk management people in the other part of the building. We got process improvement in another part of the building. Strategy people. You get a lot more synergy when you seamlessly integrate all of these methods like gears in a machine so that they really work like a Swiss watch or something that's in your engine. So you will get a copy of these slides. This is the definition I just gave you. It's enterprise managers, the integration, multiple methods. And with each embedded with business analytics, when you embed analytics, you get even more power and synergy. Examples I'll go through: segmentation and the like, especially the predictive analytics, which is the forward view. And make no mistake, this is all about achieving the strategy of the executives and making better decisions. So let's briefly talk about analytics. I could put a definition here from Wikipedia or something, but regardless how you do find it, just work backwards with the end in mind. Know a problem or an opportunity where you believe analytics will play a role. So regardless how analytics should be defined, there should be no argument as its purpose: better decisions, better actions. Analytics goals should be to gain insights and foresight and solve problems, make better and quicker decisions with more accurate and fact-based data to take actions. And I sort of lied to you. I wouldn't give you a definition. That paragraph at the bottom is not too bad as in the definition. I have authored quite a few books, and this is an example of one of them, Predictive Business Analytics. I'm going to return back. I neglected to say in my bio, you saw there were a whole series of books there. Well, there's an explanation, and I'm not expecting you to buy the books. You can go to Wiley. Chapter 1's typically a free download. But I believe that careers have a lot more to do with luck and circumstances than being smart and competent. I had 2 lucky breaks. The first one, when I was 27 years old, I wound up being a financial division controller in Milwaukee, Wisconsin, with that large conglomerate. But I had a chance after 3 years as division controller to become operations manager in the factory. Remember, my degree is industrial engineering. And I used the phrase, I then had to eat the accounting data that I had been serving as the bean counter controller upstairs. I found much of that information to be at best useless and at worst dysfunctional and misleading. And that was a real wake-up call to me about the difference between external financial statutory reporting for government regulatory agencies and internal management accounting used for insights and making better decisions. The second lucky break was in 1988. KPMG struck an exclusive contract with the Harvard Business School professor Robert S. Kaplan. Many of you will recognize his name from the balanced scorecard work, which I'll talk about briefly. But he did the pioneering work in activity-based costing, and KPMG recruited me from Deloitte. I loved being at Deloitte, 7 years, but I didn't want to pass the opportunity. So got trained by Kaplan, implemented ABC for clients for many years, wrote a book, and that led to more books. So that's the explanation. Incidentally, when you get this slide, chapter 1 is a free download. So there is a continuum or spectrum for analytics. We start with descriptive, pie charts, histograms, and the like. This is all looking backwards. Diagnostic, notice there's a black dot. That's an outlier, kind of like on the exponential curve. Then when we go to the future, we've got the predictive view. And incidentally, when my co-author and I wrote that book, Predictive, Business Analytics, well, that's Mount Everest, as high as you can go. And then prescriptive analytics showed up, which is much higher. You can think of it as optimization, linear programming and the like. So let's now talk about enterprise performance management. This will take me 3 or 4 minutes to go through this list, and then I'll dive deep into several of them. What's caused interest? The first one is executive frustration with strategy failure. Most executive teams are quite good at formulating strategy. Their frustration is failure to successfully implement it. And there's a fair amount of empirical evidence. In Chicago, and I'm a native of Chicago, love Chicago, Chicago pizza, you're probably familiar with it. There's an executive recruiting firm, Challenger, Gray and Christmas, and they monitor the involuntary turnover of CEOs in North America. The firing of CEOs, it has been increasing every year. And I believe the reason why is post-Enron and that disaster, board of directors take their governance job far more seriously. And a good example would be Carly Fiorini at Hewlett Packard. She didn't implement the strategy, they fired her. Number 2, increased accountability. Today there is no place to hide. Managers and employees will be monitored. They will be measured. It doesn't necessarily mean their job's at risk, but it could adversely impact their salary increases and job promotion. 3, more rapid decision-making. Unlike a few years ago when you could test and learn and have meetings in conference rooms, people will be on the phone, go or no go, yes or no. They have to make a decision in almost near real time. 4, mistrust of the managerial accounting system for transparency and accuracy. The reality is most line managers do not trust the management accounting system. They know it's flawed. Why? Because of overhead cost allocations. We'll talk about that, the butter spreading of overhead. 5, poor customer value management, the thing that Morton basically and I have a real interest in. The reality is customers are the source of financial wealth creation for shareholders and owners. We need to connect customer creation, value creation to shareholder creation. I'll describe how to do that. Number 6, contentious budgeting, poor resource capacity planning. This may surprise you. I think the annual budgeting process is such a disaster and is so broken. My recommendation is stop budgeting. There, I probably caught your attention. But that begs the question, what was the purpose of a budget in the first place? And how might we replace it with some of these enterprise performance management methods? I'll show you how. 7, dysfunctional supply chain management. Now, this may not impact all of you. Some of you may be in the B2C, business to consumer, retail, but those of you that are in the supply chain, the issue is here. Customers view their suppliers as the enemy. They basically try to negotiate lower prices. If they put a supplier out of business, so what? We can always get another supplier. That's got to stop. It needs to be a marriage. Supply chains are competing against other supply chains. So they have to work together to discover mutually beneficial projects or initiatives or improvements that'll save all of them, the trading partners in the supply chain. And finally, number 8, unfulfilled return on investment promises from large IT systems like enterprise resource planning systems or customer relationship management systems. And the issue here is if you ask a chief information officer, an IT director, 3 years after they've gone to the long journey to implement a large ERP system, you ask them, how well do you believe the return on investment has met or exceeded what the ERP software salesman sold you on 3 years ago? Many of them will be hard pressed to say it has. They said, golly, we spent 3 years implementing this thing. I'm not sure we've got the return. The issue here is most of the ERP systems produce transactional data, but what the EPM systems is they convert the data into information. And so the real ROI comes from the EPM systems. It's like seeds from the ground that produces the return on investment. So I'm going to now dive deep in the next 30 minutes into these 4, 1, 4, 5, and 6. Let's start with the first one. Failure by executives to execute their well-formulated strategy. And this is where the balanced scorecard comes into play. So you notice I have 2 ellipses underneath. I've got the strategy map, but the arrow is going into the balanced scorecard. I'll get to that and why in a second. But above both of them is the vision and mission statement. Arguably, that's more important. That's the job of the executives. They need to set direction. Their job is to answer the question, where do we want to go? But what the strategy map and its balanced scorecard answers is a different question. How will we get there? What are the projects or the initiatives to accomplish or core processes we need to improve? Now this may surprise you, but many organizations allegedly claim, oh, we have a balanced scorecard. And I ask them, do you have a strategy map? They look at me like I'm from outer space. I believe the strategy map is 10 times more important than the balanced scorecard. The balanced scorecard is a feedback mechanism. The intelligence, the GPS, like in an automobile, is in the strategy map. So the strategy map and its balanced scorecard, they're mechanical. They help realize that vision mission. Remember all the gears in the machine. Now, here's a fictitious example of a strategy map. Now, when Kaplan and Dr. David Norton created it, there were 2 reasons. The first reason is executives were overreacting to financial results reported at the end of the period. They said, you need to shift your attention to non-financial metrics reported and collected during the period so that you can react to them, okay? And then the second reason was Most managers and employees don't understand the executive team strategy. I mean, just for example, in your organization, if I walked in the hallways and randomly interviewed 15 employees and said, quick, 45 seconds, can you articulate your executive team strategy to me? How many of them could do it well? Probably few or none. Well, if the managers and employees don't understand the executive team strategy, then how do we expect them to understand what they do each day, each week, contributes to the strategy execution? So what Kaplan and Norton came up with these 4 perspectives that have cause and effect relationships from bottom to top. It starts at the lower one, learning and growth and innovation. If you're accomplishing those objectives in those little squares, the rectangles are strategic objectives, then they'll contribute to the internal process improvement objectives. If you're accomplishing them, they'll contribute upward to the customer satisfaction, loyalty, retention objectives. And if you're accomplishing them, they'll give the financial objectives. Now, those arrows, those are measures. We call them key performance indicators. You get what you measure. If you can't measure it, you can't manage it. So we use those measures and targets on the measures to basically help align the behavior and priorities of the managers and employees with the strategy of the executives. So to sort of summarize, if you start at the bottom, the learning environment will stimulate process excellence. Process excellence will lead to customer intimacy, retention, loyalty, and that'll create the financial value for the executives. So one way to think about this is imagine if every employee in your organization every day could answer this single question. How am I doing on what is important? How am I doing on what is important? Well, the first half of the question is relatively easy to answer. They turn on their computer screen in the morning. They may have 3 KPI dials. Is the dial favorable or unfavorable to the target set by the executives? The challenge is the second half of the question on what is important. What should the KPIs be that we measure? So a strategy map and its balanced scorecard provides this answer. The overriding purpose of a strategy map and its balanced scorecard is to make mission and strategy everyone's job. It's almost like making owners out of the employees and managers. Now, let's move on to the next problem. Mistrust of the managerial accounting system and its flawed cost allocations and misleading cost reporting, outputs, products, standard service lines, channels, customers, and outcomes. And to solve this, we do move to activity-based costing. And I know ABC has a bad reputation from the last few decades. Problem was consultants or companies designed models way too large, way too complex. No one could understand them. They collapsed under their own weight. They couldn't be maintained. And people say, oh, ABC doesn't work. No, it does work. It's just full absorption costing done correctly. Now, my simple way of defining it is this. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines also feel when the accountants take this large amount of indirect expenses, commonly called overhead, which incidentally is increasingly substantial. Sometimes it can be 50% indirect, 50% direct. So it's a material amount of spending. And they spread it like butter across bread using cost allocation factors like in manufacturing, number of labor hours or number of labor currency, square feet, square meters, number of employees per cost center, and the like. None of those cost allocation factors reflect the true consumption that the products and the standard service lines consume of the end-to-end business processes and the work activities that belong to them. So if you were to decompose those overhead into multiple cost pools, basically the activities, and then reassign them to the products or standard service lines using a cause and effect relationship, we call it a driver, you will discover, compared to that butter spreading, in reality, some of the products and service lines were way overcosted. The others must be undercosted because it's a zero-sum error game. And that means, although it does reconcile in total for the auditors and the external financial audit, it's wrong in the parts. And that means the CFO in the accounting department is providing flawed and misleading information to their line manager. So the simple definition is ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. Now, little history on ABC. The reason it has grown in interest has to do with this diagram. Over time, of the 3 universal components of any organization's expense and cost structure, the direct recurring labor at the bottom, the direct material, the overhead indirect has been displacing the recurring. And incidentally, the reason I use recurring just real quickly, a lot of people think, oh, ABC, it's about manufacturing. No, it's for any organization. In the United States, I have read information that out of every 100 jobs in the US, only 8 make products. The other 92 deliver services, banks, insurance companies. So this stuff's universal for service organizations as well. Now, when you ask people, why is the indirect displacing the direct? Oh, they say, well, computers, automation, robots, we're like automating out the frontline workers. That is secondary. The main reason this is displacements happening is over time, all organizations have had a proliferation of diversity and variation of their products. In manufacturers, more colors, more sizes, more ranges. In banks, more types of depository accounts. Insurance companies, more types of policies. The point is this: whenever you increase the diversity and variation of the outputs, it just produces complexity. And the complexity causes the need for more and more indirect expenses to manage it. So, 30 years ago, when the indirect was a thin veneer, okay, you could allocate that little amount up like butter spreading because most of the accuracy came from the direct. That's not the case today. Simple explanation of what ABC does. Most people basically are familiar with the diagram on the left, the traditional monthly responsibility cost center statement. It's a good statement. In fact, it's an important statement. But when managers receive that report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? The answer is not much. So what ABC does is it basically translate that same 914,500 into the middle into the language of work. Notice examples: key scan claims, analyze claims. Again, I'm using the back office of an insurance company. It's a factory too. And then we reassign the activity costs into the product, services, and customers, just like the waiter or waitress in the restaurant with the individual check. We call them activity drivers. I like to say at the bottom left, when managers get this kind of report, the monthly cost center statement, they are either happy or sad, but they are rarely any smarter. ABC makes them smarter. Now, ABC is not quite as simple as the previous diagram. I've rotated it 90 degrees. It isn't, oh, we just take our ledger expenses, put them into these activity pools to objects. No, the right side's more realistic. Why? Because we have support departments that support other support departments that in turn support the frontline departments that interact with customers or deliver products or services. So it must be a multiple stage cost assignment network. Now, I want to warn you, the next diagram is going to look complex, but the second one after it, I'm going to show you a link to a paper I wrote for the Institute of Management Accounting that you can read it at your leisure. It's 30 pages. This is a true look of any organization's costing system. You've got the 3 major components: the resource expenses at the top, work activities in the middle, final cost objects at the bottom. Let's start with the final cost objects at the bottom. I call this the predator food chain. Like large mammals eat small mammals eat plants. We reassign all of the activity costs into them. And then now notice the customers are consuming the products, but they're also notice there's some activities going directly to the customers. We'll talk about customer profitability in just a few minutes, okay? Up in the work activities, we've got people activities and equipment activities. Men and women run machines, machines make products. Men and women drive buses, buses deliver passengers. So assets also do activities. Think of all of those arrows as thin straws or wide pipes where the diameter reflects the amount of money flowing through. That's why this thing always reconciles exactly to the euro or the dollar or whatever is your currency. The message here is costing is modeling. It is not T accounts and journal entries in a general ledger. I mentioned to you, because I went through that very, very fast, when you get these slides, bottom link, it's a 30-page, it's called a Statement of Management Accounting that I authored for the Institute of Management Accountants. I'm a 30-year member of the IMA. They are in what I think 140 countries with 150,000 managers. What's more important is, what is the result when you get ABC? Remember, things are going to be overcosted, things are going to be undercosted. This is a true picture of a graph. It's commonly called the whale curve. Notice that it looks like a humpback whale. The vertical axis is the net revenues minus the properly calculated ABC costs. The horizontal axis is the cumulative buildup of the cost, but it is rank ordered, starting with the most profitable product to the second most profitable product, and so forth. Now, the very last data point at the right, the 2 million, will exactly reconcile with the P&L, whether it's monthly or quarterly. In this case, it was 30 million in sales, 20 expenses to net out at 2. There's always organization shock by the executives and the managers when they see this curve, because in this real case, it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products. You lost 6 million on the remainder to net out at 2, and they can't believe it. But it's proven when you basically use the ABC model. You know, the point is, the top line is the truth. The blue line is what their belief system. Oh, there's just a few unprofitable products, but at least the top line is fact-based. And if you remember anything from this lecture, remember this: in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss of the boss of the boss. So to the degree they're making decisions on gut feel or intuition or flawed and misleading information like the blue line, the organization is at risk. All right, let's move on to number 5, customer profitability. The only value a company will ever create is the value that comes from its customers, the current customers and the new ones acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable ones. But we've got a couple of problems. The accountants and the CFO are not measuring customer profitability. They're stopping halfway down on the income statement at just the gross profit margin line. They're not bothering to take the remaining expenses, distribution channel expenses, selling expenses, marketing expenses, cost to serve. So we have to go all the way to the bottom. So visually, what I'm describing is, if the entire rectangle here was the expenses for a month or a quarter, the accountants are only calculating for the shaded area. And it'd be nice if the indirect would be using ABC, which is not. But what about the distribution, sales, marketing, general accounting? That's far more important. And there's several reasons it is more important. You know, because again, customers view their suppliers basically as really enemies in many ways. And they look at them as commodities. So basically, a supplier has to provide differentiated services to different types of customers to become more profitable. Here's the other problem: angel customers and demon customers. I love this book. The message here is, every organization is going to have high maintenance and low maintenance customers. So examples of high, excuse me, examples of high maintenance customers: always changing delivery schedule, never buying standard, always special, always returning goods, always calling help desk. Angel customers, you love them. Never change delivery schedule, only buy standard, never call help desk, never return goods. If those two types of customers bought the exact same volume and mix at the same price, they're not equally profitable. Why? Because the high maintenance customers, the demons, are causing so much more extra expenses for you. You know, what really caught my attention, though, I'll get to, is the subtitle: discover which type of customer is which and turbocharge your stock price. So this is how we connect customer value creation to shareholder creation. Incidentally, this book was by marketing faculty at Columbia University. It doesn't really talk about accounting it. So with ABC, you can get a profit and loss statement for each customer. And you'll get layers and layers of margins because each of the activity drivers coming in like an onion skin. And in this fictitious example, you can see that this customer had a 30% gross profit margin for the products and services they bought. But between the 30 and the 8, 22 more points of profit margin are eroded and lost, nothing to do with the products and standard services, all with distribution, selling, and marketing. And if we calculate this for each customer, we can then put them onto a grid where the circle intersections are a customer. Now, the vertical axis is the product mix gross profit margin, you remember above the line. The horizontal axis is the below the line, that cost to serve, And now things become obvious because the most unprofitable customers are in the bottom right. Why? Because they're buying low profit margin mix that using ABC, you've got much more accuracy and they're difficult to serve. The most profitable customers are in the upper left because they're buying high margin from you and they're easy to serve. And now the name of the game is move the dots from the bottom right to the upper left. And Morton, that would be a lecture from a different person than me. That would be a marketing person. But what they would say is some of the techniques would be, well, cross-selling and upselling. If they buy a set of golf clubs, can I sell them a golf shirt? If they buy the golf shirt, can I send them a second one? Unbundling and fee-based. Look, the airlines have been now charging for baggage or for a middle seat to an aisle seat. Banks have got these charges. So the idea, though, you first got to have the facts. Let's move on to the next number 6 of the causes, contentious budgeting. I said the budget is typically a fiscal exercise by accountants. It has 2 problems. It's disconnected from the executive team strategy, and it's not based on future driver volumes. This is sort of a quiz. At your organization, how many of these boxes would you tick? Our annual budgeting process is invasive and time-consuming with few benefits. It takes 6 months from beginning to end. It requires 2 or more executive tweaks at the end. Once we publish the first draft, the executives don't like it enough, go change some of the numbers. It's obsolete in a couple of months after we publish it anyway. It starves the departments with truly valid needs. Okay, there's going to be an increased workload next year for this department. We'll give them a couple of employees. They really need 10. It caves into the loudest voice and political muscle. That's those veteran sandbaggers, got people like me, bald head. They've been in there. They know how to play the game, how to sandbag that, spreadsheet of budget that they submit to you. It incorporates last year's inefficiencies in this year's budget. The process is inefficient, we replicate it. It's the last one bothers me the most. When a manager is a couple of months from the end of the fiscal period and they can see that they're not going to spend all of the budgeted expenses that were allotted to them, what do they start doing? They start spending foolishly, needlessly. Why? Because they know that their next year's budget is going to be pegged to a baseline of how much they spent this year. We call it use it or lose it spending. Let me see if I can describe how some of you do your budgeting. You give all of your line managers a spreadsheet. They fill it out for every ledger expense in their P&L, in their general ledger from January to February. Someone in the department accounting then has to consolidate all the spreadsheets. You bring in the revenue forecast from sales. You give it the executive, say, that's okay, but not good enough. So you put all the spreadsheets back to the managers. They lower some of the expenses, gets consolidated by the accounting department back to the executives. That's a little bit better, but not good enough. Up, down, up, down, up, down, up, down, up, down. Come on. You almost want to ask the executives, what number did you want in the first place to stop us from doing all of this spreadsheet stuff? But the spreadsheets isn't the way to go. We need to basically be a little more sophisticated. I call that, spreadsheet budgeting. It's incremental. Look at this example. We predict what the end of fiscal year is, column B. We give them a 5% incremental increase for inflation. Formula, column B times 1.1, copy down. I hope you're laughing. How can enterprise performance management resolve this? Think about the amount of spending as a result of 2 river streams. The upper river stream is the recurring, repeatable expenses. The lower river stream is the non-recurring, non-repeatable expenses. They're coming from projects. Okay, for the upper river stream, basically this is where we want to think a little bit of industrial engineering. We take the ABC system and we calculate it backwards. In other words, we now forecast the volume and mix times the rates to solve for the level of capacity. A way to think about that is this. For the historical view to the left, the spending is known. ABC will calculate the work activities and cost objects, but we get a bonus. We get unit level cost consumption rate, cost per blood test in a hospital, cost per material move in a factory, cost per processing an automobile loan. And then in the predictive view, we forecast the volume and mix at the bottom. And this is what I call industrial engineering 101. I think it was second semester, my freshman year at Cornell University in 1967. There's the equation. The sales demand volume and mix times the unit level cost consumption rate equals the capacity required. In other words, the number and type of employees and their wages and salaries, purchases with suppliers. So that's the upper river stream. For the lower river stream, we move to enterprise risk management. This is a popular grid used by the enterprise risk management community. Each of the circle represents a type of risk that could occur in the future. The diameter is the amount of money to mitigate it. So we can't spend money to mitigate every single possible risk, but the ones that are on the upper right, because the vertical axis is the severity of the risk event, the horizontal axis is the probability. So the ones that are in the upper right corner are highly probable and going to be painful. Let's mitigate and spend money on it. And then also remember from the strategy map, we fund those projects and initiatives that came up to accomplish the strategic objectives. So I've decomposed the two river streams. The shaded ones are the upper one. I know it's a complex diagram, but I'll go through it really quickly. Look at the very bottom shaded box, derived budget. Notice from the top, it's the operational budget. That's coming from the unit level consumption rates. From the top, we've got the forecast volume and mix. From the left, we multiply the two, we get the capacity, number of person hours, pounds, kilograms, number of employees, and so forth. We monetize it, euros, dollars, whatever the currency, that's a good number. From the left, we've got the capital budget, which I didn't talk about, but everyone's familiar with that. We've got the strategy budget. That's the amount of spending to accomplish the strategic objectives from the Kaplan and Norton strategy map. We've got the risk mitigation budget. We bring them together. That is a much better number when we consolidate it than those spreadsheets up, down by cost center. Now, we're still going to have the same problem with the executives. See that diamond to the right? Is it acceptable? Give it the executives. Nope, they want a better number. That means we need to go back and change some things. A temptation might be, well, why don't we postpone or eliminate some of the capital projects, some of the strategy projects, some of the risk mitigation projects? All bad. That puts us at risk. The lever to basically go here is unit level consumption rates, productivity improvement. Get 2-3% productivity. This is where the process improvement, lean management, Six Sigma people come to play. Now, this does get tricky when you go to the predictive view, because when we go to the predictive view, we need to classify the behavior of each resource as sunk, fixed, step fixed, or variable. And the classification of that depends on the planning horizon. Because in the very short term, you can't adjust capacity up or down. You got fire employees on Tuesday and hire them back on Wednesday because there's more order. But as you go out weeks, months, years, you could replace full-time employees with temporary contractors. You could lease assets that you would have bought. So you really got to think like an engineer. And I just want to briefly mention that a professor at Copenhagen Business School, who decades ago stimulated me to really understand it, was Zakken Wora. Many of you will not remember him. He passed away many years ago. Zakken Worre. The CBS they can tell you about him. He had debates with Kaplan, because Kaplan was primarily using AB for strategic purposes, but Zakken Wora said, no, you got to also look about it for decisions made in the future, what if scenario analysis and the like. So let me start bringing it together. How does all of this look on a single page? Well, think of this as a circulatory system. The big purple box is your organization. That's your employees, your assets, that's your capacity. Look at the box, and I'll go into this deeper in the next few slides, but the customer loyalty or satisfaction, notice the arrow going over the top to the right and in. We're now connecting customers to shareholders. Very important. Let me take you individually into each of where's management, accounting, and analytics in my diagram? I didn't put it in. Why? Because the output of management accounting and analytics is pervasive. It goes everywhere. So how does the diagram work? Start at the customer satisfaction box to the left. The executives will formulate the strategy and mission based on needs of customers. Yes, I know some of you are familiar with, competitive advantage kind of stuff, and I'm blanking on the Harvard professor. I'll come up with it later. Once the executives formulate the strategy, it will be communicated with the strategy map and KPIs into the scorecards at the bottom, and then the scorecards provide the feedback to employees. Remember, if every employee could answer, how am I doing on what's important, they'll see that with the targets versus the actual. And when every employee can answer that, how are we doing on what's important? Now let's go from the organization to the customer. CRM, customer relationship management, targeting. What marketing and sales is asking is, what types of customers are more attractive to retain, to grow, to win back or acquire? Which types are not? And how much should we optimally spend with deals, offers, coupons? Well, remember, the customer profitability calculation answers that question for marketing and sales. Now go to the counterclockwise circle. That's the process people. Take the customer order, complete the order. The older people will remember way back, Michael Hammer, 70s, business process reengineering, tilt the organization 90 degrees. Don't look at the organization chart, look at the end-to-end business processes across, and then basically the most popular and dominant end-to-end process is order fulfillment. It's universal. So that's kind of the area of ERP. I don't have time to talk about lean accounting. If you are interested in lean accounting, please send me an email address. I'll share some material. Also, if you look at the bottom left of all my slides, that's my website, www.GaryCokins. There are free downloads in the tab. You don't have to pay for anything. It's a lot of the content that I've written. Can you see the bubbles flowing? This is happening every minute, hour, day, week, month, year. These are like veins in your system. But if to the degree that any of those veins may be constricted, then the money doesn't go to the shareholders. Look, it leaks into the sewer, inefficient processes, poor targeting of customers. The best executive teams know if you're not started on EPM, they'll say, well, where should we start? Well, which vein is most constricted? If it's a strategy, do the strategy map stuff. If it's understanding profitability, do the ABC stuff. My message is, do these in a few months, not years. And one thing I did not talk about, I'll briefly share with you. I help clients and actually train consulting firms how to implement activity-based costing in 3 weeks, not 6 months. It's called rapid prototyping with iterative remodeling. It starts with a workshop with 6 or 7 cross-functional employees in a room. You build a high-level ABC model very quickly. Its purpose is not to have any accurate information. Its purpose is so the morning of the next day, you bring in the executives and line managers. They see it. It's like a debriefing. The light bulbs go on with everybody. Oh, that's how we get rid of that butter spreading. Oh, that's how we could do benchmarking with apples and apple Oreos. Oh, that's how we could understand customer profitability. You do a couple of iterations, it's good enough. Remember, for management accounting, it's okay to be, well, we have the phrase, it's better to be approximately correct than precisely inaccurate. You don't have to be that detailed, and modeling basically gets you there quickly. So now let me start concluding with my frustration, and hopefully we'll have maybe a few minutes for Q&A. Why has the adoption rate for all of these methods been so slow? This really frustrates me. I mean, Kaplan wrote a book in the 1970s, Relevance Loss, The Decline of Management Accounting. I have empirical evidence that 95% of companies still continue to do butter spreading. It's pathetic. Actually, I'm probably showing my ways. I think many of the accountants are in the 1960s, or some weren't even born then. We've got to get into the 21st century. Line managers deserve much better information. So what are some of the barriers? The first barrier slowing the rate is technical, IT related. It could be dirty data, low quality data, but the IT function has something called extraction, transform, and load, ETL, that it can purify it. The second problem is the perception barriers, that it's too complex or it's unaffordable or it's not worth the effort. And as I just mentioned, with rapid prototyping, you can have a permanent, repeatable, reliable ABC system in 3 weeks. Also, strategy map and balance scorecard. Again, I didn't have time. I have a one-day workshop that create a strategy map and balance scorecard with KPIs in 1 day. It doesn't mean it's done. It just means now you learn. People learn through doing. But the real barrier is the third one. It's got nothing to do with systems, software, technology. It's about people. It starts with resistance to change. It's human nature. People like the status quo. Only babies like change, diapers. But other barriers, fear of others knowing the truth. Oh, I don't want the other departments to know what my costs are. Fear of being measured, fear of being held accountable, weak leadership. There I said it. Not every executive team's got the highest IQ, So the real issue here is if you really want to get buy-in, you've got to have some behavioral change management skills. But how many of you have degrees in sociology or psychology? Probably none. You're all Newtonians like Isaac Newton, the physicist. To you, the world's a big machine. Give me the gears, levers, pulleys. You've got to have a little bit of Charles Darwin, Darwinian sense and respond. So to conclude, I'm contrasting cover of one of my books with greasy, grimy gears. Imagine some of the teeth are broken, some of those gears are disengaged. Put that in your car engine. Will it work? Yeah, but what will your fuel efficiency be? Low. Now look to the right. Titanium gear, spinning faster revolutions per minute, lubricated, digitized. Put that in your car engine. Now what's your fuel efficiency? Much higher. Now replace the metaphor of fuel efficiency with rate of shareholder wealth creation. So make the revolutions per minute of corporate performance management and business analytics gears spin better, faster, cheaper. That's the process improvement, safer, risk management, smarter. Action steps, get educated. Thank you. You're doing that by listening to this webinar. Rapid prototyping, start small, think big. Incentives, I don't have skills or expertise in motivational theory, but I know it's important. I have left a few links there to articles I've written that you can get. Your success depends on how well and how fast the right information intelligence gets to the right people. I'm done. So Morten, first of all, I said it would be an MBA in 60 minutes. I covered everything that's in the curriculum at Stanford University, Harvard, INSEAD, in Europe, So Morten, I know we only have 6 minutes and it's a professional courtesy to end on time. How would you like to proceed?
Well, first of all, thank you, Gary, for this very passionate tour de force of performance management systems. As you said, we have 5 minutes or so for questions. So if there are questions in the audience, feel free to jump in either in the chat or simply speak up, and we will give you a chance to while we have Gary here.
While they're doing that for 30 seconds, I'm pointing my finger to a not-for-profit called the Profitability Analytics Center of Excellence. I encourage you, just write that website, Profitability Analytics, or just do a search. There's 4,000 members, it's free, and there's a lot of frameworks there, how you can basically get advice and implement, and there's different interest groups, including academia, faculty.
Yeah, I agree.
So, Morten,
I concur, and maybe I can say a few words about that as well. PACE, right? PACE. I think they're doing a tremendous job also in sort of partly also in revising the whole curriculum, because as you said, Gary, this is also about revised education. I mean, where we are coming from currently probably needs some kind of, reality check in terms of where we should be going as accountants also in the future. So I can also highly recommend the PACE for sure. But maybe I can ask a question then. Okay, there's a question now that I'll give space for that. There's a question from Kim in the chat. So was Sagan-Wall more correct than Kaplan then? I'm not sure that
my
was
answer is yes. My answer is I don't remember. I think I was still at KPMG, but all of a sudden we heard this thing. Oh, Professor Kaplan is being debated by a faculty member at Copenhagen Business School. It's like, what's that all about? And Kaplan, I believe, and his sidekick, Robin Cooper, was primarily looking at strategic profit margin analysis. So that's always looking through the rear view mirror, last quarter, last month, last quarter. And what Zachin said, but look at decisions are the things that impact the future. And when you're going to go into the future, you've got to think about capacity management relationships. And I already gave you those examples of classifying the behavior of resources, sunk fixed, step fixed, variable. And that resonated with me being an industrial engineer. I went, wow, ABC is good for profit, but it's also good for what if scenario analysis, for, return on investment. So to answer your question, I think Zachin basically put his thumb on the famous Robert Kaplan.
Thanks, Gary. There's another question. Maybe we can have time for that as well from Jesper. He says, thank you for the exciting presentation and the mini MBA. Do you have recommendations regarding more focus on customer value or readings in this regard?
Well, if you go to Pace website, I actually did a 60-minute YouTube video that you can listen to me do a deep dive on customer profitability and how to do it. If you are in B2C, business to consumer, send me an email. This involves customer lifetime value, because that's a little different category, because customers go through life cycles. Young girls become teenagers, teenagers become mothers, mothers become grandmothers, they buy differently and the like. But I encourage, also, I think in my website, if you go to a link, it's how to measure and manage customer profitability. It's an article I published in the Institute of Management Accounting's Strategic Finance magazine.
Yeah, great article. And Jesper, also feel free to contact me. I have a couple of recommendations as well.
I forgot to say, Morton's got expertise, and Morton's got a lot of my articles that I've written, which he can share with you.
Absolutely. Final question.
Let me, if there's not one, go ahead.
Yeah, but just the final question, Gary, while we have you. There's a question from Thomas, my colleague from Aarhus. Gary, what's your take on TDABC, time-driven activity-based costing?
Thumbs down. I'm not a fan. If you
Why not?
go, it's way too complex, and it's just not worth the effort. I mean, you got to have stopwatches and 30 seconds, and I know there's some appeal, but activity-based costing, which is a push, I call it rate-based costing, can get you 95% of the accuracy that you'd get with time-driven ABC, and time-driven ABC could be 10 to 20 times more work and effort. I know hospitals have been trying to use it here in the United States, and almost every one of them that started with TD-ABC abandoned it and just went back to traditional ABC. There's an article in Strategic Finance magazine, go to IMA, and I co-authored it's time-driven ABC compared to traditional ABC, and you can see my opinion of time-driven ABC.
Yeah,
I'm pragmatic.
It's a nice teaser, because the event that I teased a little bit for that we're having on the 16th, I think this process mining technology, where you can actually map activities and how long they take in real time, could be an interesting, combination with time-driven activity-based costing. But that's a whole other discussion.
No, Morton, I just believe it's a professional courtesy to end on time, and we're 1 minute over, but I'm just going to I did see a question from someone about any more for service organizations. I'm not sure, but let me just say, it's all universal. You can use the same methodology for banks, insurance companies, travel agencies. It doesn't have to be a tangible product is at the end. I also just say, when people ask me, what is the one major lesson learned by organizations implementing these? I basically say there's two lessons. One, don't underestimate resistance to change. It's a big deal. People are going to block you from implementing. And the second one is the causality principle. Modeling is cause and effect relationships, and you've got to embrace modeling. So I suggest we're done, because I've embarrassed about holding them 3 minutes over. I like to stop on time.
Let's stop and say thank you very much, Gary. Big round of applause for you for taking part in this. We're very happy. Danish Accounting Network to have you here. Thank you.